It's certainly been a challenging year for property investors, hasn't it? And throughout the year, the media has been reminding us about how rising interest rates are hammering our property markets, and commentators keep reminding us about the uncertainty of our economic future. It's easy to see all the risks and the problems at the moment, but in 5 years' time, it's likely that we're going to look back at a lot of missed opportunities because the rear vision mirror is always clearer than the windscreen. Finance journalist Morgan Housel put it well when he said, every past decline looks like an opportunity and every future decline looks like a risk. That's why once a month I catch up with leading economic commentator Pete Wargent for these big picture podcasts where we look at the macro factors affecting our economy and our property markets to bring our years of experience of perspective to you. And that's what we plan to do again today as we sum up what's happened in 2022 and give you some ideas of what we think's ahead for 2023. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Over the last couple of years, we've been producing these monthly Big Picture podcasts with Pete Wargent to help bring you our years of perspective as we interpret what's happening in our economy, not just in Australia, but around the world, and how this affects our property markets. But if you would have asked me at the beginning of this year, what would we be talking about? I wouldn't have thought we'd be talking about inflation at a rate of 8%, 8 consecutive interest rate rises, a war overseas with no end in sight, and the lowest consumer confidence in decades. But here we are. Now, regular listeners will know Pete Wargent well, but if you're new to this podcast, well, firstly, welcome. But the reason I'm keen to chat with Pete about these is not because of his academic credentials as a chartered accountant, chartered secretary, or because he's got a financial planning diploma, but I enjoy our chats because of his credible perspective he's bringing being an international investor and business person. So welcome, Pete.
Thanks, Michael. It's always great to be on.
Now, last time we spoke, you were in Australia, and we suddenly come online and I see you're over on the other side of the world again.
Yeah, well, it's, I guess, 2021. It was very difficult to travel internationally, in and out of Australia anyway. Could travel around Europe. But yeah, it's great to be able to actually get around the world again, because as you know, I'm a travel junkie and it's great to be able to see a few places.
Well, it also gives you an idea of what's going on in other parts of the world, because that definitely affects Australia as well. So look, as I look back on 2022, I think it's going to be one of those years for the record book, but every year seems to be special. I don't know what normal is anymore, Pete. This year, it was the year of inflation. Last year, there was COVID came back. The year before, there were lockdowns. 2019, there was an election which made the year unusual. The year before that, there was the Haynes Royal Commission. So I don't really know what's normal. But if we finish off this year, you're going to see that there was another interest rate rise in December, which made us have 3% interest rate rise over the year. We haven't seen a spike like that since the middle 90s. Then inflation's at its highest point in 30 years. Supply chain and labour issues caused home building costs to go up at the fastest pace since, well, I guess when GST was increased, and that gave it a quick boost. We've had historically significant population changes, greater growth in the regional areas compared to the capital cities for the first time in 4 decades. But Pete, it's been one of probably the fastest property market correction I've witnessed. But the silver lining is it's probably going to be the shortest property downturn we've experienced. So if I look back, that were some of my highlights for the year. When you think about it, what were your highlights for the year?
Well, yeah, what a year it's been. So I guess the thing for me was that in 2021, the international borders in Australia were closed. So I went overseas, couldn't get back into the country without doing quarantine, which the kids weren't so keen to do. So I was actually out of the country. So this year, international borders were open again. we were able to travel in and out of the country, which was great. But also as Australia reopened, we got this kind of hedonism boom. You know, people were allowed to go and eat out and go to pubs and clubs and restaurants again. So we got this sort of reopening excitement and a boom. But now things are just starting to slow again. Only just, but towards the end of the year, as you mentioned, interest rate hikes starting to just impact consumer spending and sentiment. So look, there's loads of moving parts, but basically the economy rocketed back. We got the lowest unemployment since 1974. Jobs were booming, incomes were growing, but the cost of all those lockdowns is that inflation shot up, as you mentioned, and now interest rates are rising just to cool things down again. So a heck of a year.
Yeah, and it's been a very different year for the property markets. The last couple of years in 2021 and 2020, sorry, I've lost track of the years now, Pete. 2020 and 2021, during that boom, every property went up in value. Well, almost every property in regional Australia and capital cities, A-grade properties and even C-grade properties, when there was a once-in-a-generation boom. But the property slump this year started in Sydney and Melbourne. But interestingly, even before interest rate rises, it started early in the year. And remember, interest rate rises only started in May, and the slump has spread around the country. And it was started by the more expensive markets, which started to have the sharpest declines for a while. But that's always the case, Pete, isn't it? The higher end of the market, the more expensive segments, tend to lead the booms and lead the downturns.
Yeah, you generally find that the upper price quartile is more volatile through the cycle. So, as you mentioned, bigger booms and bigger busts. So, you get a lot of sort of media talk about prices nationally about 8% off their highs. But that's, I guess, two things. Firstly, that's after booming 24% last year and even a bit more early this year, as you said. But I think that's the thing. Yeah, in some areas, prices are off much more than 8%, often the areas which actually boomed the most. But then in other parts of the market, actually not down much at all. As you touched on just before, I guess it's a lot is being driven by sentiment, and particularly, well, what's going to happen to interest rates. Now, on the day of recording, it looks like Australia is getting quite near to the top of the interest rate cycle. The US may not be quite there yet, but they're getting close to a pause with inflation. Just overnight, the inflation figures for November came out, slowing quite significantly. One thing that's just slightly different in Australia, we've had employment and participation rates at record highs. The US has had really struggled to get the participation rate back up, and that's resulted in very strong wages growth. We don't really have that in Australia. So if I had to guess, interest rates in the States will probably peak at 5% for the funds rate. But in Australia, we probably won't get much above 3%, maybe another hike or two, but we're pretty close to the top, I think.
Oh, I'd agree with that. We'll get onto that in a moment. But if we just look again at the property markets, I think one of the other significant changes has been that apartments have held their value better than houses. I guess it's a combination of a couple of things, affordability, and people are now getting back to the lifestyles they had before. They shunned apartments and high and, I guess, medium density living for a while.
Yeah, there was definitely a race for space through the pandemic. Now it's just beginning to reverse. I think you can just see in some parts of the country, like, say, the Blue Mountains or Wollongong, suddenly rental listings are actually rising again. And that partly reflects some COVID reversals, people heading back into the cities, and just starting to see a little bit more push from firms and businesses to get people back into the office at least 3 or 4 days a week, if not full time. So, yeah, just a bit of a reversal. I think the thing with apartments as well is that the cost of higher density construction and delivering those projects is absolutely rocketed over the last few years, and that's going to underpin the price of new apartments. It's very difficult for developers to deliver affordable apartments now, and we've seen a number of developers going under because obviously fixed price contracts are the norm in Australia.
Sure, that means that a lot of those apartment complexes on the drawing boards are not going to be financially viable to start until end values increase considerably. Why would developers take that risk? And they can't, because they've got to make the pre-sales in most cases to get funding. So as you say, that's going to exacerbate one of the other challenges we've seen this year, which is the rental crisis. We've got historically low vacancy rates around Australia for houses, but also apartments. And that's going to now get even lower when we've got this influx of students back again and immigrants back again. It's also been an amazing year of rental increases. And I know there's been a lot in the media about the ugly, greedy landlords. Well, I've seen a lot of our clients, they're not ugly, and I don't think they're greedy either. And they're not raising their rents because of inflation or because of the cost of the rising mortgages. It's just the market. Just like a couple of years ago, they had to meet the market, lower their rents, help tenants with subsidies or free periods because of COVID. Now, supply and demand suggests that rents should go up. But if you look back over the last decade, rents haven't kept up with inflation. So they're just playing catch up, Pete.
Yes, I think there's a few sort of macro trends that have driven it. I think there's been a big surge in the demand for single-person households, something I remember you predicting some years ago, actually, and that has come to light. Also, the average household size actually declined quite significantly over the past 2 or 3 years as people wanted an extra bedroom. I think a lot of the demand has gone away from sort of B grade and C grade office stock, and everyone wants an extra bedroom, so they've got the ability to work from home. So the demand for rentals has gone up. I think the other thing is we saw a huge drop in the number of temporary visa holders in Australia through the pandemic, but now they've absolutely rocketed back by more than 500,000 since the third quarter of last year. So we're back up to 2.2 million now, and we haven't even seen the permanent migration start to ramp up yet. So it's partly a race for space thing with people wanting the extra bedroom, but it's actually just the numbers now, people coming back into the country in droves. We just got the numbers for October. Net arrivals over 200,000 or just about 200,000 for the month. So if you extrapolate out to next year, well, we could see population growth of 500,000. As you mentioned, developers aren't really that keen to build at the moment. There's no respite in place, and with lending standards pretty tight for investors, rental increases are going to be the order of the day in 2023 as well.
I think a couple of other factors have exacerbated the rental crisis. We know that a lot of investors sold up their investment property. That showed recently with our property investment sentiment survey and also in Pippa's property investment sentiment survey. Similarly, a lot of investors sold up and in general to owner-occupiers, and more investors are thinking of selling, which in my opinion, in general is the wrong idea. I don't know everyone's personal circumstances. But there's also been the talk about buy-to-rent, this new system that has worked well overseas coming to Australia, and that'll be the answer for affordable accommodation when large corporations build large complexes specifically to rent. But Pete, only a couple of weeks ago I read Mirvac was very proud of their new complex in Melbourne opposite Queen Victoria Market, and what they said was, hey, look how good we're doing. We're getting 20% more rent than a comparable two-bedroom apartment in the neighbourhood. So buy-to-rent isn't necessarily the answer for affordable accommodation.
No, not at all. You mentioned having a perspective from overseas. Well, we've seen a lot of build-to-rent go up in London in recent years. In fact, a huge chunk now of the new housing supply in the United Kingdom does come via build-to-rent. But as you just touched on, well, the market rents charged in build-to-rent in the UK is well above the normal rental for property, so about 11% higher. So it's not really solving an affordability issue. I think the problem is, who's going to build all these units? They're just going to be high-rise, generic units, but you're not going to get capital growth on that type of property. So if the rental returns aren't there, then there's not really much incentive for the big developers to get into the space unless there's incentives from the government. And I don't think construction will be picking up until prices are rising again. Like, it's very popular, particularly with some of the progressive governments who they like the idea of build to rent, but in reality, in London, it's been very, very mixed in my experience. Not always a great experience for the people renting, and the rents haven't been cheaper anyway.
Now, I called it the wrong thing. I said buy to rent by mistake, so thank you for correcting me. It is build to rent, which is the concept that a developer builds a whole lot of apartments, a whole complex, and rents them out rather than sells them off to individual investors. And the government is talking about helping subsidise these with land tax exemptions or other incentives to help big corporations do this. But Pete, if the government is subsidising this, I guess it's public housing in a different form, and it's taking your and my tax money and putting it into the hands of these developers.
Yeah, without getting too political, I guess, I think there'll be some superannuation funds eyeing up the sector. Yeah, I mean, I heard it said once that housing can either be a good investment or it can be affordable, but it's very difficult for it to be both. And I think that sort of underscores the challenge here, is that what is the goal of the sector? Is it to provide affordable rentals? Is it security of tenure? But if big corporations want strong rental returns, well, it's pretty difficult then. Look, my many years of experience in real estate, when nobody owns properties in a building, as you well know yourself, if there's no incentive for people to maintain the upkeep and the common areas, those developments can deteriorate over time unless, in this case, the big developer is going to sort of maintain and put the money in for repairs, which, it can fall away over time. I think a lot of this stuff looks good on paper, but we'll have to see.
Sure. I guess a couple of other interesting trends, if we look back over the years, was there's an increased interest in renovated properties because building or renovating became too hard, partly because costs just kept blowing out, partly because it was difficult to get trades. And another unfortunate event that happened this year, or a number of events, was a number of builders and developers went bust. They got involved in fixed price contracts and couldn't complete them with the cost of building and labour going up. Another interesting trend, I guess, is the continuation of the hybrid work model, isn't it? More people are going to work from home for a period of time, and that's going to affect the sort of accommodation they want to live in, Pete.
Yeah, I think so. Definitely businesses are starting to get a bit keener for people to get back into the office, but it has been happening more slowly than might have been expected. And I think, as you said, there's something of a hybrid model coming into play. So I think at one of your events at the Wealth Retreat, Simon Kustenmacher talked about the gravitational pull of the capital city. So people might not need to be in the office 5 days a week, but they still, generally speaking, want to be within striking distance of employment hubs. Even though in theory people can work fully remotely, most often people want to be within a reasonable commuting distance of the bigger employment centres. I think it will gather pace eventually. At the moment, of course, the balance of power is all with employees because we've got the lowest unemployment rate in over 50 years, but that will change. Probably sooner than we think, actually, as unemployment starts to rise again. And then, of course, things will normalise in time. It doesn't feel like it when you're going things in real time. It feels like things are only changing slowly. But I think things will go back to something a bit closer to normal over the next year or two.
As will the move back to the city or the suburbs from regional locations, and only those locations that are in good commuting distance to the CBD are likely to still hold up well. Now, a moment ago you mentioned Wealth Retreat, and before we press the record button, you and I both talked about Wealth Retreat, which we get a hold at the end of April 2023 on the Gold Coast, and you were saying you're going to, even though you're one of the main presenters and you have been for a long, long time now, you said you're going to sit in the back of the room, as you always do, and plan the next 5 years or the next stage of your life. And that's what we all do. And that's, I guess, the theme behind Wealth Retreat. Where are you going to be in 5 years' time? And with the world changing in front of our eyes, just being in a room of already successful business people, entrepreneurs and investors makes a big, big difference. So I know you've got a lot of benefit out of it. You've recommended it to a lot of people. So I'm looking forward to it. And if people are interested, go to wealthretreat.com.au. I'll leave a link in the show notes. You'll have a chance to catch up with Pete, me, Dr. Andrew Wilson, the Metropole team, and a whole group of, well, the best faculty I could put together to help you get to the next level. Now, Pete, let's have a quick look at some of the big influences that are going to affect our property markets in 2023. And I guess inflation is still going to be in the news, but it seems like it's likely that it will peak very soon if it hasn't already got very close to the peak.
Yeah, I think as we sit here today, inflation has probably peaked. It won't be reported The Q4 figures won't be reported until early in the new year. So it will still be in the headlines for a little while, but you can already just start to see it in things like certainly in fuel prices. You've seen those just starting to come off. And I think there's still going to be some inflation around next year, particularly rents, as we mentioned. It was interesting to see Louis Christopher from SQM Research. He always puts his annual forecasts out, the boom and bust report, and he sees sort of the base case, housing prices rising 3 to 7% next year. He believes the rebound will be driven by Sydney and Perth, and I tend to agree. I mean, Sydney has suffered the largest peak to trough decline, but also we've got stamp duty reform coming into play from mid-January, which will bring a lot of first-time buyers into the market. So I think the rebound will probably be driven from the bottom of the market upwards. And some of the other sort of cities around the country, I mean, listings are very, very low. I saw CoreLogic had their monthly figures out. Well, listings are more than 26% lower than they normally would be for this time of year. So there's very few forced sellers around. There's a lot of people sitting on the sidelines, though. And as we mentioned, even the Reserve Bank is talking about growing concerns about housing supply as the population grows. And we've got vacancy rates for units at, well, the lowest we've seen, basically.
Well, our friend Stuart Weems has called the market bottom in a bold article that was in the Australian a couple of weeks ago. Andrew Wilson reports asking prices rather than sale prices, which is a leading indicator, and they've held steady or risen for a while. Louis Christopher from SQM Research similarly reports asking prices, and there's a really good correlation between what vendors are asking now and what they eventually get. It doesn't mean they get those prices, but there's if asking prices are holding rather than falling or going up, they're a good leading indicator. But we shouldn't just be looking at one metric of what's ahead. So if you look at asking prices, auction clearance rates, which have held up well, vendor metrics, as you said, there's not many vendors. Discounting isn't occurring much. Days on market haven't blown out a lot. So there's actually a lot of factors suggesting that we're near the bottom of the property market, including, I think, confidence. That's the big thing that's held things back. But a lot of borrowers are figuring, hey, interest rates are near their peak. They may go up once or twice again, and inflation's near its peak. So once confidence takes over fear, the market will start turning around, Pete.
Yeah, I think that's it. The fundamentals, well, the economy's been too hot this year, very strong. Incomes are going up. Population growth is probably going to be the highest on record next year on all the indicators I'm looking at. So I think confidence is the key. As you mentioned, everyone's waiting for the peak in interest rate. So cash rate target today, 3.1%. There's no board meeting in January, and then the Reserve Bank will meet in February. So I guess if you look at what futures markets are predicting, well, I guess for the US, the futures markets are expecting the funds rate to go up close to 5%, but then the Federal Reserve cutting aggressively in the second half of next year and in 2024. Now, as I said, Australia doesn't have wages rising quite so quickly. So interest rates aren't expected to rise so far, but also the decline will be more gradual when that comes in the second half of next year as well. So I think what people are really looking for is a validation that we're close to the top. I think you can see it in the consumer sentiment surveys. People are sensing it, but until we actually get the green light from the Reserve Bank, there's a lot of caution out there. So it might carry on for a few months yet.
Well, as you say, Pete, the next CPI figure will be high, and that will be for the December quarter and won't be reported till January. But the Reserve Bank also knows there's a lag between their interest rate rises and consumer behaviour. So it'll also be interesting to see how consumers spend over the Christmas period. I think the Reserve Bank also recognises, all the big banks, the regular banks recognise that there's a challenge next year when those fixed rate mortgages eventually convert to higher variable rates. So even if the Reserve Bank doesn't increase rates, there'll be a de facto rise in interest rates for a lot of borrowers.
Yeah, so the fixed rate cliff, as it's termed, is just starting to happen because a lot of those fixed rate loans were taken out 2 years ago. So now they're resetting to variable. So yeah, some households haven't yet felt the pain, or even in some cases haven't realized what's coming. I don't think we'll see a big surge in defaults though. If you look at 30-day arrears, well, they're at basically record lows at the moment because everybody has a job. Landlords have seen rents going up 10 to 20% or more in some cases. So there is obviously going to be some pain, but it will probably be reflected in just a slowdown in household spending rather than a surge of defaults or forced selling. If you think back to what happened in the pandemic, the regulator introduced a 300 basis points lending assessment buffer, but the cash rate has actually gone from 10 basis points to 3.1%. So we've actually seen the whole of that buffer used up since May. So the RBA probably won't want to go too much further with the hiking cycle, as that could create some problems. And in fact, actually, that lending assessment buffer should now be released. We've seen the bulk of the rate hikes now for the cycle, and it's actually making it harder for some people to refinance. So it should actually be dropped back to 250. Whether that happens soon or in a month or two, we'll just have to wait and see.
Now, I agree with that. Now, the banks recognise that there is this, well, let's call it a cliff, then the fixed rate mortgage cliff, but they also, and I heard this from a professional colleague who went to one of the big four banks' private client meetings where they talked about this happening, but they also said that the banks are going to support their clients, as they did during COVID. They don't want to become mortgagees in possession. So whether they change the loans from principal interest to interest only for a while so the payments are less, or whether they extend the terms of the loan, or they do other things, there is unlikely to be significant mortgage stress next year, or I guess a lot of people selling up. So I think that's the main downside or challenge, headwind that could affect our property markets. But another factor, we talked a bit about inflation, I guess, is also what's going to happen to economic growth, because the central banks have been raising their rates, including our Reserve Bank, but around the world they have, to take the heat out of the economy and, again, of course, to take the heat out of inflation. But so far, growth's been supported in Australia. The latest GDP figures came in showing that, yeah, the economy slowed a little bit, but Aussies are still spending up, mainly on discretionary items, Pete.
I mean, we did get the sort of reopening boom, and there was a big sort of a hedonism play. But actually, if you just look in real time, the ABS has some new indicators like monthly business turnover, and they can just see now that retail is just starting to tail off. I mean, it's coming from a high level because people have been spending, but yeah, it will start to fall away a bit. I think GDP next year, well, forecasts are for 1.5%, so definitely a slowdown, but really that's to be expected. You know, if you think about what we've had this year, very, very strong growth. I think as well, if you actually look at GDP, sort of nominal GDP, well, commodity prices have been phenomenally strong, really, really strong in Australia. They'll probably at some point start to calm down a bit. Things like coal and iron ore and gold, you know, seen some really big export figures. Well, I guess that will start to calm down as well. But I think that's, you know, what we actually need. The economy is overheated this year. We just need some breathing space. Population growth is happening again. And I think, you know, that's one of the things that's really going to be a safety release valve. If you think back even 3 or 4 months ago, you know, when you were traveling, you know, there's just signs up everywhere, you know, staff needed, hospitality, retail. Well, those vacancies are dropping away now, and that's a really good sign that the staff shortages are starting to be sort of ease away, because working holiday makers and students are coming back into the country. So I think that will take some of the capacity constraint pressure off.
Well, in your regular daily blog that I enjoy reading, you commented that the Seek job ads fell recently. Just another sign that even though we're still looking for a lot of people to go into the workforce, it's not as dire a situation as it was before.
Yeah, it just fell another 5% or so in November. So, that's 6 consecutive monthly declines now since May. So, yes, I mean, job ads went extremely high. And I guess that was the cost of the border closures. If you look at things like hospitality workers, food trades, retail and service managers, we're starting to fill those positions now. That was where there was real shortage of staff, and in some parts of the country there were no staff. But it's things are just starting to right themselves now. The job ads are coming back down to earth, so that's a good sign. It might take a bit of time for unemployment to start rising again. It's a good sign. It does mean that we don't face the risk of a wage price spiral like some other countries do.
Sure. The other leading indicator we tend to look at is housing loan commitments, and they've continued to fall, and they've been falling for a while now, haven't they, Pete?
Yes, I mean, again, I guess they've probably fallen about 23%. If you look at monthly commitments from the peak right back at the start of 2022, but even then we're still miles above the pre-COVID levels, so there's probably a bit further to go in terms of normalization. An interesting thing when you look at those numbers, that the lending for new homes and lending for new construction has really been crunched. I think if you look at new home sales, they've absolutely plummeted. They're back down to, even below where we saw in the pandemic. So I think a lot of this points to serious challenges on housing supply next year. People are, they often talk about potential for a crash in property prices, but one of the factors you would look for is a big oversupply of dwellings, but we've got the absolute opposite problem in Australia. We're going to have record high population growth next year, but building approvals are already back down to a 2-year low if you look at them on an annualized basis. So we've got construction slowing and the headcount rapidly rising. Yeah, there's a few sort of cautious people around in terms of borrowers, but the fundamentals are actually going to shift to a stronger perspective next year.
Well, you and I have been around a number of property cycles. It's easy to look in retrospect and say, yeah, this is all played out for this reason. But I can see this being a shorter downturn than previous cycles because, as you suggested, as we've been discussing, there's a lot of things underpinning our markets at the moment that are going to put a floor under further property price falls. So I think when we have this discussion in a year's time, even though we're going to be having discussions every month in between now, but if you're going to have this discussion in a year's time, I think we're going to find that the property market will have bottomed and started to rise again, but slowly. We're not going to have another boom. There's no real reason that'll happen. That the markets are going to be very fragmented next year, and some segments will do better than others. But I can't see us not talking about the rental crisis. I think that's going to continue for quite some time, Pete.
Yeah, definitely. It does have that feel to it, doesn't it? I don't think we'll see prices going from falling to suddenly booming again. Look, it's absolutely possible in the US. If interest rates get cut aggressively, you might see housing start to rebound quickly. But it feels like in Australia, we might get another rate hike or two. But then even though markets are pricing for declines in interest rates in the second half of next year, it's more likely to be a gradual situation. So I think we'll probably see a shallower bottoming out of the market. Yeah, I mean, looking at rents, I've seen plenty of instances of rents going up 20, 25% this year, but it's going to be more of the same next year. Yeah, it'd be interesting to see how that situation is resolved, because at the moment there don't seem to be any solutions coming. So some challenges ahead for the rental market for sure.
And as we get together once a month in these big picture podcasts, there's going to always be lots of news. So thank you for doing these on a regular basis in 2022, Pete. Enjoy your Christmas in the winter, in the snow, while we are going to be in Melbourne and probably have a winter and a cold season here too, despite it being summer. And look forward to having these regular chats with you next year.
Yes, always a pleasure to be on, and be interesting to see how things play out in the first quarter next year.
Now, if people want to, over the Christmas time, spend a bit more time finding out about you, reading your blogs, listening to your podcast, how do they find you?
Pete Wargent Blogspot is the easiest place. You'll usually find me writing a daily blog over there. It's my daily brain dump, but that's usually the best place to get hold of me. Pretty easy to find.
And you're on Twitter, you're very active there, but I'll leave a link in the show note also to your great podcast, Pete's Property Pod, so people can find you all over the place. Thanks for your time, Pete.
Cheers, Michael.
In a moment, I'm going to share my mindset message with you. But before I do, I just want to pick up something that Pete Wargent and I were talking about, and that's Wealth Retreat, which we've been running once a year for a small group of already successful property investors, business people and entrepreneurs. And we're running it again on the Gold Coast in April, at the end of April 2023. But hey, don't count yourself out. Let me quickly explain that Wealth Retreat, as I said, is a closed-door, high-impact 5-day event. And it's where already very successful people work on planning the next 5 years of their life, just like we said Pete was going to, like I do every year. But then they walk out with a whole toolbox full of tools to help them achieve their goals, create lifetime wealth, to leave a legacy. Because apart from the outstanding faculty, attendees tend to learn a lot from the other attendees at Wealth Retreat as well. We spend the full 5 days together. Imagine having breakfast, lunch and dinner with, I don't know, Ken Race, Andrew Wilson, Tom Corley, Pete Wargent, me, and the rest of the faculty. What would that do to you? Well, every year I open the door to 2 or 3 enthusiastic, well-read beginning investors as well, or those who are planning to go into business. My aim is to give them a leg up, the sort of advantage I would have liked to have when I first started. You're going to have a chance to 10x your investments, your business or your life when you join us. But my suggestion is go to wealthretreat.com.au, find out about it, take a time to read about this special event that we're holding in April 2023. We only hold it once a year. And just leave your name there, leave your interest, because I speak to everybody who joins us at Wealth Retreat to make sure it's appropriate for them and they don't waste their time or their money. You see, if you're already a very successful investor, particularly if you're keen to take your property investment to build it as a real business, then joining Wealth Retreat would make a huge difference to you. In fact, I guarantee your attendance there. I guarantee your success. So if you're serious about getting to the next level, building lifetime wealth, leaving a legacy, then I urge you to go to wealthretreat.com.au and read about this special 5-day intensive event. And even if you're not as far advanced as that, please learn about it. What would it be worth to you to spend 5 days with my faculty and me? And more importantly, the other people in the community who are generous, amazing people. They're willing to share with their fellow members and reveal incredible gems, wisdom and secrets. wealthretreat.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
What is success? Look, if you're like me, you're interested in learning about success. I guess that's part of why you're listening to this podcast. You're interested in reading or hearing about successful people. I know I enjoy reading about the habits, the philosophies, the behaviours, and the influences of those who've already accomplished great things. Not only do I find them motivating, but I think by understanding how and why successful people do what they do, I pick up tools, I get ideas that I can use to improve my own life. But I guess the question is, what is success? As I researched over the years, I came to realise that success has got many different definitions, depending on who you ask. The dictionary definition of success is that the accomplishment of one's goals, the desired results of an attempt, or that one succeeds. Now, I know many people think that success is all about money and fame and power. But the many stories of unfulfilled lives and burnout amongst the so-called successful people, the successful sports people, the celebrities, the actors, shows, however, success is not only about achievement, it's definitely not about possessions. In my mind, success in life is much more than just money and power. It's defined by your actions. It's defined by how you live your life. So what's needed to succeed in life? I've come to the conclusion that there are 6 essential aspects to happiness and to having a successful life. The first one is physical health. You need to be physically healthy to have the energy to engage in life. If you don't have your health, you can't function, you can't be successful. Having all the money and being stuck in a hospital bed really doesn't help, does it? The second element of success is mental fitness. You need to be continuously engaging your mind, learning and growing, experiencing new ideas, getting better, pursuing mastery, putting your ideas to work to accomplish your goals. The third of the 6 essential elements of happiness and success is emotional health. You need to be fully aware emotionally. You need to feel good about yourself. You need to have a positive self-image. If you're depressed to the point where you can't function, you can't be successful. So you need physical health, mental health, emotional health, and you also need social health. You need positive relationships with people that you love, people that support you. Friends, loved ones, people you can trust, they make you a better person. They inspire you to be better. Humans, we're social. Boy, did we find that out when we couldn't be out socially during those lockdowns in COVID. Humans are social, and if you don't have people you care about, and they care about you, you can't really be successful, can you? The 5th element is purpose, meaning, spiritual health. You make a positive impact on other people's lives, giving meaning and purpose to your work and what you do, your daily life. If you've got purpose, meaning, spiritual health, you're successful, aren't you? It's one of the things you need to be successful, because this keeps you focused and inspires you to overcome all the day-to-day struggles that we are inevitably going to have, to the setbacks that are part of everybody's life. And then, yes, there is the 6th part, and that's material wealth. In other words, it's the basic levels of food and shelter and clothing that all of us need, that's paid for through money. If you're too poor to have those basic things, you end up with more stress, struggling financially, and you can't be successful. So success is shown in a number of ways, and you can function and be happy in the short term without all of these elements. But in the long term, if you're missing one, I believe it's unsustainable. You're probably going to become unhappy. So, of course, something will have to change in your life for you to go on to the next level. Emotions are how your subconscious communicates with you. They're one of the reasons humans are so resilient. So if you're unhappy, it's probably your body's way of telling you something is wrong in your life and that you should do something about it. So back to what is success. I've come to the conclusion that success is the drive for long-term sustainable happiness. In the short term, you can find happiness with all sorts of things. You know, how many people like you on Instagram, how much money you've got, going out and partying, small wins, spending time on YouTube, alcohol, shopping, you know, that quick binge you get, the excitement you get with shopping, movies. But in the long term, if you don't have all those 6 essential elements I just mentioned, you're not going to feel happy. You're not going to feel successful. Hey, by the way, don't compare yourself to others. Don't compare your chapter 10 to somebody else's chapter 30. Don't worry about what others say or do. Only you can know if you're truly successful or not. And that's only the case if you're on the path to happiness over the long term. So as we enter into a new year, I want you to concentrate on making your year more successful. One way is by coming along twice a week to listen to this podcast, to learn about things. But remember, it's more than just money. It's more than just property. It's more than financial. So look after yourself. Just to reiterate, the 6 essential elements of happiness and success are physical health, mental fitness, emotional health, social health, having a purpose, having a meaning, and of course you need material wealth as well. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?